Think about buying a new TV. It's an exciting purchase, right? You probably start by considering what you need. Do you want a bigger screen for your living room or a smaller one for your bedroom? Maybe you're looking for the latest 4K resolution or a smart TV with all the apps you love. You probably look at screen size, picture quality, and price, right? You might even read reviews online or ask friends for recommendations. You want to make sure you're getting the best value for your money. Investing in stocks is similar, but with one big difference: complexity. When you buy a TV, you're making a one-time purchase. But when you invest in stocks, you're buying a piece of a company, and that comes with ongoing responsibilities. You're not just buying a product, you're buying a piece of a company. This means you need to understand the company's business model, its financial health, and its growth potential. It's not just about the price you pay today, but the value it can bring in the future. This means your research needs to be deeper. You need to look at financial statements, understand market trends, and even consider the company's management team. It's a lot more work than just picking out a TV. Don't just chase the latest hot stock tip. It's tempting to follow the crowd, especially when you hear about a stock that's skyrocketing. But remember, what's hot today might not be tomorrow. That's like buying a TV based solely on a flashy commercial. Instead, take your time. Do your homework. Look beyond the hype and understand what you're really getting into. Understand the company and its potential. What are its strengths and weaknesses? What are the risks involved? How does it compare to its competitors? These are all questions you should be asking. Your investment decisions should be based on solid research, not fleeting emotions. It's easy to get caught up in the excitement of a rising stock, but remember, emotions can cloud your judgment. Remember, investing is a long game. It's not about making a quick buck, but about building wealth over time. Patience and discipline are key. Approach it with a level head and a commitment to learning. The more you know, the better your investment decisions will be. So take your time, do your research, and invest wisely. Imagine buying a share of your favorite coffee shop. You wouldn't just look at the price of a cup of coffee, right? You'd want to know how many customers they have, their costs, and their competition. The same goes for stocks. Don't get fixated on the stock price alone. Dig deeper into the company's financials. Look at their revenue, profits, and debt. Consider their industry and competitive landscape. Are they a leader or a laggard? Understanding the business behind the stock is crucial. It's like knowing the ingredients before you take a bite. Market capitalization is a fancy term for a simple concept: the total value of a company's shares. It's a crucial metric that investors use to gauge the size and value of a company in the stock market. By understanding market capitalization, you can get a clearer picture of a company's overall worth and how it stacks up against its competitors. It's calculated by multiplying the stock price by the number of outstanding shares. For instance, if a company has a stock price of $50 and there are 1 million shares outstanding, the market cap would be $50 million. This simple calculation provides a snapshot of the company's market value at any given time. Think of it like this. If a company has 100 shares of stock and each share is worth $10, its market cap is $1,000. This straightforward example helps illustrate how market cap works in real-world scenarios. Its market cap is $1,000. Market capitalization is not just a number. It represents the collective confidence of investors in the company's future prospects. A higher market cap often indicates a more established and potentially more stable company. Understanding market cap helps you put a company's size into perspective. It allows you to see how large or small a company is compared to others in the same industry. This can be particularly useful when making investment decisions, as it provides a benchmark for evaluating potential risks and rewards. It allows you to compare companies within the same industry. For example, comparing the market cap of two tech companies can give you insights into which one is more dominant or has more growth potential. This comparison is essential for building a diversified investment portfolio. It's like comparing apples to apples instead of apples to oranges. When you compare companies of similar market caps, you're making a more accurate assessment of their relative strengths and weaknesses. This approach helps you make more informed investment choices. Market cap is a valuable tool for investors of all levels. Whether you're a seasoned investor or just starting, understanding market capitalization can help you navigate the stock market more effectively. It provides a foundation for evaluating companies and making strategic investment decisions that align with your financial goals. Even the greatest investors have areas they know well and areas they don't. Warren Buffett, for example, is a master of understanding consumer businesses. But he's the first to admit he doesn't understand every industry. This is where the circle of competence comes in. It's about focusing on industries and companies you understand. It's about playing to your strengths and avoiding areas where you lack expertise. Don't feel pressured to invest in everything. Stick to what you know. It's like sticking to the recipes you're good at when you're cooking. Section 5. Does this investment fit? Practical questions to ask. So, how do you determine what's in your circle of competence? Start by asking yourself some key questions. Do you understand the company's products or services? Can you explain their business model to a friend? Do you see a clear path to future profitability? If you can answer yes to these questions, you might be onto something. If not, it might be time to move on. Remember, investing is not a guessing game. It's about making informed decisions based on your knowledge and understanding. Section 6. The indexing advantage, a solid strategy for many. For many investors, especially those starting out, index funds offer a great way to participate in the stock market. These funds are designed to mirror the performance of a specific market index, providing a broad exposure to the market. This means that instead of trying to pick individual stocks, which can be risky and time-consuming, you can invest in a wide range of companies all at once. An index fund tracks a specific market index like the S&P 500. The S&P 500 is one of the most well-known indices, representing the performance of 500 of the largest companies in the United States. By investing in an index fund that tracks the S&P 500, you are essentially investing in a slice of the entire market. Think of it like buying a basket of stocks instead of just one. This basket includes a variety of companies from different sectors, which helps to spread out your risk. If one company in the basket performs poorly, the impact on your overall investment is minimized because other companies in the basket may perform well. This diversification helps to reduce risk. Diversification is a key principle in investing because it helps to protect your portfolio from the volatility of individual stocks. By spreading your investments across a wide range of assets, you can achieve a more stable and predictable return over time. Index funds are known for their low fees and historical performance. Because they are passively managed, index funds typically have lower management fees compared to actively managed funds. This means more of your money stays invested and working for you. Over the long term, these lower fees can add up to significant savings. They are a great option for investors who want a simple, hands-off approach. With index funds, you don't need to constantly monitor the market or make frequent trading decisions. This makes them ideal for those who prefer a more passive investment strategy, allowing you to focus on other aspects of your life while your investments grow. Investing doesn't have to be complicated. Index funds simplify the process by providing a straightforward way to invest in the market. Whether you're a seasoned investor or just starting out, index funds can be a valuable addition to your investment portfolio. Index funds provide a solid foundation for long-term growth. By consistently investing in index funds over time, you can take advantage of the power of compounding returns. This means that the returns you earn on your investments are reinvested, generating even more returns in the future. With patience and discipline, index funds can help you achieve your financial goals. Section 7. Stop-loss orders, not always a safety net. Stop-loss orders are designed to limit potential losses. They automatically sell a stock when it hits a certain price. While this might sound appealing, it's not always the best strategy. The stock market is inherently volatile. Stop-loss orders can trigger unnecessary selling during temporary dips. This can result in missing out on potential gains when the market rebounds. Remember, investing is a marathon, not a sprint. Don't let short-term fluctuations derail your long-term goals. Section 8. Riding the market waves. Real estate and stock market parallels. Imagine you're selling your house. The price isn't fixed. It's determined by what buyers are willing to pay at a given time. The stock market works in a similar way. Prices fluctuate based on supply and demand. Just like a bidding war can drive up the price of a house, positive sentiment can push stock prices higher. Conversely, negative news can lead to a decline in prices. Understanding this dynamic is crucial. It allows you to view market fluctuations as opportunities rather than threats. Section 9. The bottom line. Investing with confidence. Investing in the stock market can seem daunting, but it doesn't have to be. By understanding the basics, you can approach it with confidence. Remember to do your research, stay within your circle of competence, and focus on the long term. Don't be afraid to seek out guidance from financial professionals if needed. Investing is a journey, and the more knowledge you have, the smoother that journey will be.